Hi, I'm Jimmy. In this video, we're going to look at 5 value stocks that could be great stocks to buy and hold for long-term investors. I'm using discounted free cash flow to value each of these value stocks, and each of the 5 look like they could be undervalued at this time, and ideally they could be something we would consider jumping into in 2022. Okay, now I just wanted to let everybody know that we've started building a website that will allow for us to research stocks and very quickly calculate the fair value of said stocks using discounted free cash flow and a handful of other valuation methods that might be more appropriate to different types of companies. We're hoping to have the website up and running in the next 6 months, so within the first 2 quarters of 2022. And if you decide to sign up today, before the site goes live, well, we're locking in your price to whatever you sign up for at today. Forever. The price will never go up on you. So I'll leave a link in the description below as to how you can sign up for the website if you're interested. And in the meantime, you actually get access to our private investing community. We do 3 live streams per week over there. Okay, so let's jump right into this now. First up, we've got the United Health Group, ticker symbol UNH. United Health is obviously a healthcare company, and when we look at the fair value of United Health, well, they look quite undervalued. Now, for me, I like to use a required rate of return of about 7.5%. And with that required rate of return, it looks like this stock could be worth more than $800 per share. Now, a more textbook way of using a more textbook version of required rate of return is to use something like the company's own weighted average cost of capital. And using the United Health's own weighted average cost of capital, well, their cost of capital, which is, by the way, about 10.1%, well, the stock still looks like it would be undervalued using that as the required rate of return. Plus, the stock also pays a dividend, so that's a nice bonus. Now, if we're looking for some exposure to healthcare plus a small dividend, well, I think that this one could be a good one for us to consider. Now, before we move on to our next value stock, I just want to point out that I think it could be helpful for us to keep an eye on the company's weighted average cost of capital. That's why we included, that's why we're going to be putting it on the website. So I did a whole video as to how to calculate the company's weighted average cost of capital. But if we're comparing 2 companies that are similar, many times we can take a quick look at their weighted average cost of capital just to see what it costs them to raise money. So basically, this is a combination of how much equity do they raise, stocks, how much money do they raise using equity, and how much money do they raise using debt, and what does each group cost them. So in theory, you want a lower weighted average cost of capital, but many industries should be compared to each other. So again, it's something we should just keep in the back of our mind. And as we go through these, we'll notice there's one at the end that we'll see that it looks quite low, but there's a reason for that. We'll come back to that in a second. For now, let's jump on to our next value stock. Okay, our next one is the United Parcel Service, ticker symbol UPS. So UPS is currently trading at about $213 per share, and we calculated a fair value of about $233 per share. So we get some upside there. Now, we can see down here how many analysts are covering this, or how many analysts are contributing to our free cash flow estimates. And we can see that there's more than enough analysts, so that should build in a little extra confidence. If there was just one, I would hesitate a bit as to whether or not we can believe that number. And we could also see that, yes, there's an expected pullback in the amount of free cash flow coming out of 2021. So it looks like free cash flow is going to drop in 2021 and then continue to climb higher after that, which seems to make sense from what happened in 2020 and 2021. And then they're expecting some progress going forward. So I think that this stock is absolutely worth a deeper dive. And at the current price, this could be a great buy. Plus, just like United Health, they also pay a decent dividend. So not too bad. Okay, next up, we got a stock that looks like it could have even more upside than United Parcel Service. That is Kohl's, ticker symbol KSS. So Kohl's is currently priced at about $50 per share. And using our required rate of return of 7.5%, well, it looks like the upside for this stock could be enormous from the current fair value, from the current stock price, I mean. Now, if you're wondering why I use a required rate of return of 7.5%, that I do it because that's about 5%, that's about a 5% premium over AAA corporate bond ratings, corporate bond yield. Before they dropped interest rates by 1%, I used to use 8.5%. Then they dropped interest rates by 1%, so I dropped my required rate of return by 1%. Now you might look at that and say, that's not enough for me. I need my portfolio requires that, and that might very well be the case, which is why when we look at some of the other required rates of return for this stock, well, we can see that even using 10%, well, the stock still looks undervalued. And much like the other stocks on our value stock list for 2022 so far, well, this one also pays a dividend. So again, some upside there. Okay, now moving on to Caterpillar, ticker symbol CAT. Caterpillar is another dividend payer, which is great, but from a value perspective and using both my own required rate of return of 7.5% and the company's cost of capital, well, it looks like the stock still has some upside. And just so we're all on the same page, one of the most common questions that I get is, isn't 7.5% too small of a required return if the market is averaged, let's say, 9.5%? Why are you using 7.5%? And I think that it's important to point out that the required rate of return is not how much you're expecting to return each year. It is your floor. It's the minimum. It's I require at least 7.5%. Now, I did a video not too long ago about picking the correct required rate of return. And in that, I go through different examples of how if you have a required rate of return that's too high, many times you'll never get the opportunity to buy a stock because you're pricing yourself out of it. So that's why I like to go with a more moderate required rate of return. And then I go ahead and I like to add a margin of safety to my calculation. Okay, now let's jump over to another stock that comes out of the energy industry. And this one also has a very big dividend that could make it even more interesting right now from both a value and a dividend perspective. Next up, we have Enterprise Product Partners, ticker symbol EPD. And as we can see, EPD has a current dividend yield of about 8%. Now, we might look at that and say, how are they doing 8%? That seems too high. And that is because this company is classified as an MLP, or Master Limited Partnership. And basically, they don't have to pay corporate income taxes as long as they pay out at least 90% of their profits as dividends. They actually call them distributions, but it's a very similar concept. So you end up with they don't have to pay corporate income taxes, so you end up with a much higher dividend yield. So that's how the dividend is there. And then using free cash flow estimates from analysts for this stock, well, it looks like this stock could have some additional upside on top of the discount, on top of the dividend rate. So that could be a great thing. Now, this is actually the company I was talking about before that has a very low cost of capital. That looks like it could be great, but I've actually analyzed this industry before, and many of the companies have a lower weighted average cost of capital. So if you're ever comparing those to each other, comparing companies, make sure you compare companies in the same industry. MLPs tend to have a lower cost of capital. Now, if you want to get access to this website once it's up and running, I've got a link down in the description below and right here to sign up. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.